Hey everybody, it's Dan here. Hope you're all doing well in quarantine. I'm doing pretty well. Could use a haircut, but otherwise good. The point of this video is to talk about why I think Apple and the market in general is overvalued and is possibly heading for a crash. If you're new to the channel, my name's Dan, and the mission of this channel is to help you build your wealth through saving and investing. So let's jump right into it. Point number one, why do I say the market's overvalued? Well, let's look at the price-earnings ratio of the S&P 500, 500 of the top companies in the U.S. stock market. Now, the price-earnings or PE ratio just takes the price you pay for something divided by the earnings, which means the profits that that asset produces every year. As you can see from the chart, the price-earnings ratio has gone up and up recently, and we're sitting at about 26. What that means is for every $26 you put into the S&P 500, they will earn about $1 a year right now. If that doesn't sound like a good deal to you, you're not alone. That is not a good deal. Another thing to look at is one of Warren Buffett's favorite indicators, which is the value of the stock market divided by the value of the economy. So what we have here is a chart of the Dow Jones Industrial Average, which is our measure of the stock market, divided by GDP, which is the measure of the economy. Right now, that ratio is about 1.3. Now, if you look at the chart, historically, we usually do not get that ratio even to 1. If it even approaches 1, we normally have a crash afterward. So we're sitting at 1.3. That's incredibly high. The third and final thing to look at is the price to book ratio of the S&P 500. So price to book just measures the price you pay for something divided by its book value. The book value is an accounting value. You add up all the assets the company has and you subtract all their liabilities, all the stuff, the money that they owe. The result of that is the book value. So right now, the price to book ratio is getting pretty close to 4. This is also pretty high, guys. The last time we saw it get that high was around the dot-com bubble, where it actually reached 5. This is concerning. One of the worst offenders here is Apple. Let's have a look at Apple. Apple's had an incredible run-up in stock price over the past couple years, so it has been a great company to own. However, if you want to buy Apple right now, you're going to have to pay about 36 times their earnings. Not a great deal. You got to pay close to 28 times the book value. Now, some people will look at this and say, well, but Apple is a growth company. So the PE ratios and the price to book ratios are very misleading. The PE ratio makes it look like a bad deal, but really their earnings are going to be growing. So what looks like a bad deal will turn out to be great investment. To that, I would advise you just to look at their financial statement. So here's the net income, which is the profits for the company, for Apple over the past 5 years or so. You can see it in this row highlighted right here. Now, they have incredible earnings, they have great consistency, but I would not call that a growth company, which shouldn't be surprising, guys. This is the company with the largest market cap in the world at over $2 trillion. There are limits to growth. You cannot keep growing like that. All right, guys, moving to part 2. If you believe part 1, if you agree that the market is overvalued and Apple is one of the worst offenders, what forces are causing this? Well, the number one factor, in my opinion, is the rise of passive investing coupled with the fact that the S&P 500 is a value-weighted index. Let me break this down for you guys. I saw an article come out last year that passive investing now accounts for over half the U.S. stock market. Passive funds sounds great conceptually, like the S&P 500. You think, okay, my money is going into 500 of the top companies in the U.S. That's very diversified. The only problem with that is that the S&P is a value-weighted fund, which a lot of people don't realize. So if you click on VOO, that is a Vanguard fund for the S&P 500, look at their top 10 holdings. If you add this up, you realize that 27% of your money is going to just 10 companies. Worse yet, when you look at the top big tech companies here, you got Microsoft, Apple, Amazon, Facebook, and Google. 22% of your money is going to just those 5 companies. So what happens is every 2 weeks, part of your paycheck goes to your retirement account. It goes into one of these funds like S&P 500 passive fund. And everyone does this, and we're not even looking at the value of the fund because we've been taught that passive funds can outperform active funds. And the values of these companies in particular get bloated and bloated. The second factor I see happening is the rise of retail investors. So we've seen the Robinhood app, and we've seen brokers get into a commission war last year, such that now it's $0 commission fees. It doesn't cost you anything to trade stocks. So we have a lot of people getting interested in investing that probably don't know a whole lot about investing yet. And I think you can see evidence of that just by a few things that have happened this year. Number one was the Zoom versus the actual Zoom stock fiasco. What happened was we had the pandemic and everyone started doing Zoom meetings, and therefore a lot of investors had the bright idea that, well, I'm going to buy stock in this company. I mean, everyone's using it. So what happened was the stock price of a completely unrelated company using the ticker ZOOM skyrocketed. It went from $3 to about $20 within a month. The SEC had to shut it down because they realized something was amiss here. So, by the way, if you want to buy Zoom stock, the ticker is just ZM. You can also see the market reaction to these stock split announcements of both Apple and Tesla. For those who don't know, last month, Apple and Tesla both announced they were doing stock splits, and the market just reacted very strongly. Here's the price chart for the stock price run up after they announced their stock splits. Just incredible. The thing is though, guys, if you don't know much about stock splits, they're really non-events. So if you think about a pizza with 8 slices, and you have 1 slice, which means you have 12.5% of the pizza. A stock split is essentially me taking your slice, cutting it into 2 smaller slices, and saying you're welcome. It's a non-event. You have the same share of the company that you had before, percentage-wise. Okay, so if the market is so overvalued, why doesn't the smart money correct this? This is the idea with market efficiency. Mutual fund managers will see things are overvalued. They're going to use their expertise to sell off and make profit. The problem here is the whole incentive system of these mutual fund managers. They're usually judged relative to each other or relative to the return on the market. What this means is they're not afraid to do something stupid if everyone else is doing it, but they are afraid to stand alone. I'll give you an example. If the market actually tanks and goes down 30%, and you're a mutual fund manager and your fund goes down 27%, you're actually happy. Your compensation will probably be higher. You'll be rewarded because you beat the market by 3%, which is a pretty good margin there. On the other hand, if you decide the market's overvalued and you sell everything and you just hold cash, you better be right, and you better be right fast. If you call it too early and the market just goes up another 3, 4, 5%, and you're just sitting there not getting anything, you're probably going to lose your job. So I think a lot of the smart money does know the market's overvalued, and they're just along for the ride. All right, guys, now we come to the most important part of the video, part 3. What should you do about this? The market's overvalued. Should you stop buying? What should you do? My number one piece of advice is not to do anything extreme. Don't short sell the S&P 500. Don't cash out everything and hold 100% cash and wait for the crash. These are extreme positions, and the problem is, while I do believe the market's overvalued, and I hope you do as well after looking at the evidence, there is no telling when it will be corrected. Things can be overvalued for a long time, but I would be prudent. If you were paying attention last week and you saw some of the stock market reaction, especially with Apple and Tesla, Tesla lost 18% of its value in 3 days. Now, how is that? Well, a lot of the smart money investors, they're just enjoying the ride on the stock run-up, but they have put stop losses in place so that if the stock starts to go down, they will sell their shares immediately. This is why you see choppy action like we saw last week. What I would recommend though is a sector rotation. So a lot of these big tech companies have had an incredible run up in price. If you've enjoyed a nice profit from this, it's just time to sell it. You haven't had any profit until you sell it. So I would take some money off the table and I would reallocate that money to more value-oriented companies who have not had incredible prices run-ups. Companies like Intel, which trades at about less than 10 times their earnings. Altria Group is another good one. The 3M company is not bad. Looking at Verizon as well. Especially if you own some of the big tech stocks like Microsoft or Apple, I think it's time to cash out, ring the register, and reallocate that money to more value-oriented companies who have not enjoyed incredible run-ups in price. The stock market is very funny like that. As the price of something goes up, people seem to want to buy it more. When the price of something starts to go down, people want to get rid of it as fast as they can. I can't think of any other market where that is the case. But you need to resist that. You need to remember that your goal is to buy low and sell high. So if something has had an incredible run up in the price, it's probably time to sell it. All right, that's all for this video. Don't forget to hit the like button if you liked it. Thank you.